Welcome to Better System Trader, the show for systematic and algorithmic traders, and welcome to the first live show of 2024 and the first one we've done for a while. And we have a very fantastic guest joining us today. This guy is the podcast host for the Algorithmic Advantage podcast. Fantastic podcast if you want to check that one out. He's also co-founder for Aussie Turtles, strategy ambassador for East Coast Capital Management, director at ATS Trading Solutions, and just recently, in the last few hours, was called the Trend Following Professor. That's right, the Trend Following Professor by Jerry Parker. So that's a ringing endorsement. Welcome to the show, Richard Brennan. G'day, Rich.
G'day, Andrew. How are you? Great to be here. And thanks very much for getting me on.
Well, actually, you know what? You just reminded me we should thank Billy, because Billy was the person who even recommended this. I'm going to put this up on the screen, Rich, before we get started. Let's have a look at this. So Billy Grow. I don't know, Rich. Do you know Billy? I don't know who
I know Billy. He's a long-time advocate of trend following. So he's regularly appeared on Jerry's Spaces. So Jerry Parker was holding Spaces for a long time, and Billy was one of the long-term champions.
Right. Okay. Well, Billy said this is Billy's idea. What a fantastic idea, Billy. May I suggest to you, maybe one day you can invite Rich to the podcast with you. He's really very smart, which I'm sure we're going to find out today. Classic trend following too, like Jerry Parker. Listeners can gain much insights about classic trend following. So no pressure, Rich, but you're supposed to be very smart and you're going to give us a lot of info today. How about that?
Oh no, what's Billy done to me?
Okay, so anyway, the title of the show today is Surviving Uncertain Markets, very serious aspect of trading, but I'm sure we're going to have a lot of fun. Now, I did just list off a whole bunch of things about you, and I'm sure you've got your fingers in many more pies than that. But maybe first, just to give us a little bit of context for people around our discussion today, how did you actually get into trading?
Look, I got into trading, Andrew, pretty well straight after college, because I got involved with a company that the managing director was heavily involved in investing and trading. And so coming from a sort of science-based background at university, I came into this environment in this listed company here in Australia, and I caught the bug. And, probably sort of 1985 onwards, I've sort of been actively trading thereafter, at lots of different styles, but starting initially with fundamental and value investing.
Oh, okay. Well, as I mentioned, or as we're going to find out today, you're very heavily into trend following specialist. I'm not going to ask you why, because I think it's going to become very clear as we talk. So we can skip that question and we'll figure it out as we go. But so trend following specialist, and so that's obviously going to be kind of context of what we discussed today in our surviving uncertain markets theme. But before we, I guess I'd like to start with a little bit of core principles. I think it's obviously not as sexy as talking about the latest indicator, but I think that. Well, actually, why don't I ask you, why do you, I know you talk about core principles a lot on your website and in your articles. Why do you think it's so important for traders to have that kind of foundational core principles?
Look, ultimately, this game of investing is about not just sort of one event, but a career path of events. And when you're looking at events over a time series, over a very long period of time, you recognize that there are certain core principles that you need to follow to ensure survival. And for me, at least, survival is a core principle of any form of investment, because that means you're able to participate in opportunities at any point in time and not get knocked out by virtue of some bad decisions along the way. So, there are certain golden rules that are applicable to any trading strategy. And I think probably the most fundamental of all of the golden rules is survival, which means that survival takes priority over performance, as far as I'm concerned. The ability to stay in the game, especially if you want to achieve these benefits of compounding, which a lot of people don't actually get to benefit from compounding, because it's an effect that takes numerous trades to get the benefit of compounding, and only those people that are able to survive over the long term are able to achieve this miracle of compounding, which really is the ultimate edge in any form of investment over the long term.
Yeah. Well, I'm glad you said survival in there like about 8 or 10 times, because that's exactly what we're talking about today. So thank you very much. So how about we dig into, I know there's some core principles, or there's, quite a few that you speak about. I'd like to talk firstly about market dynamics. I think this one's really core principle. Could you call it that?
Yes. Yes.
Dynamics. So maybe you can talk a little bit about market dynamics, and how do trend followers look at this as one of their core principles?
So the way we view price, or the way we view a market, fundamentally is by virtue of the collective actions of the participants in that market. So what we do is we say there's lots of maybe reasons for price to move, such as fundamental factors and events that occur around the world, and news events and all of these things. But the fundamental reason the price moves is because of the collective trader impact. In other words, the buying and selling decisions of traders, and the quantum of the amount that they're trading. That is fundamentally what drives price. There might be derivative factors causing that, but when you start looking at the collective dynamics or the mechanics of the market, you're avoiding the need to assume that certain factors are driving the market. You're just looking at price itself and recognizing that the reason that price has gone up or gone down is because fundamentally we get this buying and selling activity of the participants, and you can reduce it down to a mechanistic solution, as opposed to an assumptive proposition where you're assuming that certain factors are driving things or causing things to happen. So when you look at things in a mechanistic way, and you look at things such as the impact of participants and their trader behavior in the market, you can start looking at things in the terms of what I refer to as complex adaptive systems, and how you can look at analogies to other complex adaptive systems and get clues into how the mechanistics of those systems plays out over the long term. So when we look at the collective actions of participants in the market, and we look at it over very long-term data sets, we see these universal properties start emanating from the behavior of the participants over the long term, which is reflected in the statistical histograms you can draw of the returns of a market. And one of the big things that I've noticed in any liquid market that I trade is that when you look at the daily returns of any liquid market over the long term, you notice that they've got an unusual shape. It's what you call a leptokurtic shape. And what that means is that the properties of that mechanistic behavior gives rise to fat-tailed regions in the histogram of returns, and also gives rise to the peaks of the distribution around the mean of that distribution of returns. And that unusual shape, which falls outside the shape of what we call a normal distribution, which your viewers might recognize as what they call a Gaussian distribution or a normal distribution. That's a typical bell curve. When you overlay the plot of long-term liquid market data over the bell curve distribution, you see that there are certain regions where the properties of that histogram fall outside of that normal distribution. And where it falls outside of that distribution, both at the peaks of the distribution around the equilibrium and at the left and right tails of that distribution, that's where the opportunities arise for any form of speculation. That's where the arbitrage resides in the trading model. So around the peak of that distribution, you get what we call people exploiting those properties through the likes of mean reverting strategies, things that oscillate around an equilibrium or around an intrinsic value, up and down, up and down. That tends to create a higher frequency at the peak of the distribution. And that's what we call convergent traders. In other words, traders that are looking at things converging to an equilibrium or converging about an equilibrium. That's where they extract their alpha or their edge from those opportunities around the peak of the distribution. But then also on the left and right tails, you've got where the divergent trader gets their opportunities. And they are the people that exploit opportunities that arise from price diverging away from an equilibrium. So we get the left and right tails. And when you see that these fall outside of the normal distribution, you know that there are opportunities there for speculation, both in convergent models, mean reverting, and trend following models and divergent models around the tails. And so if we could imagine, if you plot the flick of an unbiased coin, and you're looking at consecutive tails or consecutive heads, and you count those number of consecutive tails and heads, when you plot, 1, 2, 3, 4, and minus 1, 2, 3, 4, and you plot that, you'll notice that with an unbiased coin, it plots pretty well within that bell curve distribution.
Yeah.
And so any random market, any market that doesn't hold an edge, will typically demonstrate a plot in a histogram of a bell curve distribution. And that tells a speculative trader such as myself, or anyone who trades in these markets, or investors indeed, that there are no opportunities that arise in a normal distribution that a speculator can obtain a long-term enduring edge from. But when you see that the properties fall outside of that bell curve, that's where speculators pick their ears up and say, that's where my opportunity arises. So I'm a specialist I focus on the tail regions. So I'm specializing on what we call the divergent properties of markets, that they have these enduring trends away from an equilibrium. Unlike, say, a lot of traders that might focus what I call predictable traders, predictive traders, in that their assumption is that price will do something in the future based on its past activity. And that tends to be a predictive stance where you're, say, for instance, a mean reverter. Your assumption is that if prices move to an extreme, either high or low, it's going to revert back to that central median point, that equilibrium. That is a predictive premise in the assumption that it's going to do that. It's going to revert back to that equilibrium. But for a divergent trader, they don't hold that premise. They follow price, and they assume that whatever price is doing now, if it's moving out to these extremes, the assumption is that it could continue far longer than what a Gaussian distribution would imply. And, we've found this in the markets over the history, in that a Gaussian distribution typically totally underestimates the frequency of these high magnitude major events, these tail properties. And they're continually underestimating it. And so under a normal distribution, I think the probability of achieving a greater than or a greater than 5 standard deviation move, either positive or negative in daily returns, is something like a 1 in a 3.6 million chance. In other words, that's what a Gaussian distribution implies. But then when we look at the financial markets themselves, we see these greater than 5 standard deviations plus or minus, not 1 in 3.6 million chance. We see it sort of every 4 years, every 5 years, every 7 years. We see these massive moves. So we know that there is something universal in the market that is causing these extreme events. And so from my perspective, being a specialist in the area I'm in, I want to do not what the predictive traders are trying to do, because when you look at the level of people that apply predictive models, so in other words, typically when a trader or investor looks at examining a backtest, or they look at examining market behavior, they're looking for the most frequent occurrence. They're looking for the things that occur most readily, most frequently. And therefore, they're tending to look at opportunities that reside around the mean of the distribution, where you get that big peak at the mean of the distribution, because there's a high frequency of those occurrences occurring. So people that might want to chase returns, or look at the most frequent pattern, look at pattern recognition, look at mean reversion. They're looking at the things that occur with the greatest degree of repetition or frequency. Now, that is a very competitive landscape, and most traders and investors look at that. They're focused on, what is the thing that's happening now? What is the thing that I can rely on to extract an edge from? But their memories are very bad, and they forget these extreme events that they've all experienced in the past.
Yep.
And these extreme events are what I call the game changers to the long-term career path of a trader or investor. They're the things that often cause risk of ruin for certain traders that forget that these possibilities exist. And so they might have models that are worked around these very defined thresholds from their back test. They're replicating what's been seen in the past. And because they've never seen these events, these extreme events occurring in the short back tests that they've undertaken, they totally underestimate those events and they forget about those events. So they work with models that work around thresholds. It must work within this threshold and this threshold. But suddenly when the market goes extreme and works outside of those thresholds, they find themselves in a risk event that they've never seen in their backtest. And suddenly their models fail. Now, with my understanding that about 90% of participants invest in this predictive mindset, invest in these convergent methodologies, there's about 10% of participants out there who aren't looking at the most frequent occurrence. They're looking at the extreme events. So what they're doing is they're looking at risk events. They're not looking at performance events. They're looking at risk events. And the way they view this histogram is from inside out, not outside in. So what I mean there is when you look at this histogram with this leptokurtic signature with these tail properties and then the most frequent occurrence in the middle, the people that are looking for the most frequent opportunity, the things that their back test tells them is something that is now offering them an edge, they're tending to focus from what I call outside in to the most frequent occurrence, from outside of the distribution in. But what I'm looking at is from inside out. I'm looking at the extreme events, both the left and right tails, recognizing that they are the game changers in a trader or investor's career. They're the things that either kill you, risk of ruin, wipe you out, or they're the things that are the magnificent wins that you could never have anticipated. They're the things that I'm focused on. So I'm using models that are specifically exploiting those extreme properties of the tails. And in those extreme areas of the tails, that's where markets become incredibly chaotic and unpredictable. So you need a process that manages that unpredictability. Most traders are looking at predictable outcomes. What is the most frequent occurrence? How can I exploit this opportunity? What I'm looking at is a process that mitigates left tail risk. Now, what I mean there is, whilst we've got a distribution of the market that shows what we call a leptokurtic distribution with a left and right tail, in relation to my trade outcomes, I'm looking for something that always stops that left tail trade exposure I might get from my trade outcomes. So when I plot my trade outcomes, it doesn't follow the leptokurtic signature of the market. What it does is it creates a massive positive skewed signature of your trade distribution. So you get many small losses, but with the occasional very large wins. And what that does is you get this very skewed, what you call a positive skewed signature, where your trade outcomes, you only might have 5 to 10% of your trades offering these magnificent wins, and 90% of your trades being small wins, small losses, but most of your trades are actually small losses. They're the things I'm focused on, because that is the signature you need to survive in a market over the long term that displays these unpredictable properties. So that's how I view it, Andrew. And what you need with that fundamental underlying understanding is this notion of survival. Because what I mean is that in the career of a trader, what you'll find is that at any point in time, we can look at a market and we can understand what price is of that market. And when we look at the properties of that market, we recognize that the current price of the market is the current price reflected by all of those participants that have participated at that point in time. And so we look at an average. We look at where the S&P sits at the moment, where cocoa sits at the moment, where soybeans sit at the moment, where any liquid market sits in price currently is a reflection of what the current market participants, the average of all of that activity, that collective behavior, is a point in time at that specific point in time. Now, what is different is that over the career of a trader or an investor, the average achieved by the market at any point in time is different. So in other words, over the course of time of the career of traders, the vast number of traders that have participated in this market are not there anymore. 90% of traders are out of the market. They might have started 10 years ago. A large number of them have faced risk of ruin where their accounts have blown up. Some of them might have just elected to leave the market with bad performance. But that average of over time is not being reflected in the current market average you see in price.
Yep.
So if you've got a process that allows you to survive over the long period of time, you'll find that process actually floats you above the market average, because what that process is doing is it's allowing you to participate in all of the events in a successful way over the long term to achieve benefits of compounding that float you above the average over the long term. So for someone like me, like a diversified systematic trend follower, my game is decided by thousands of trades, not by any individual event, provided that all of those individual events, we cap the downside risk. We make those losses small at all times, never letting those losses become what I call non-linear adverse losses that compromise the efforts of your portfolio.
Yeah. So I think, Rich, you've just given us a mini masterclass in trend following right there. I think if traders were just to listen to that short section and really apply it and understand it, they would be better than most of the other traders in the market, as you were kind of talking about at the end there. So thank you very much for that. We've got a couple of comments in the chat. Actually, I'm glad you talked about fat tails there, because obviously it's such an important aspect of the trend following approach. But the point you touched on there about these extreme events are much more common than, how would you say it? I guess financial market theory suggests, right? So,
yes. So that's a victim. That's a victim of what the efficient market hypothesis, where it assumed that markets were efficient and they followed this normal distribution. The reality of the real markets out there, not the theoretical markets, is that these financial markets are actually these complex adaptive systems that display periods of predictability, but then they can be interdispersed with periods of very unpredictable, chaotic regime. And the whole theory of economics, which has really been based around the efficient market hypothesis for many decades, up until about the 1980s, and thereafter it started to be challenged by theories that were suggesting that that might be a theoretical model, but more realistic models display these fat-tailed properties, these extreme events, much more frequently than what the theory can account for. So under the efficient markets hypothesis, it was always assumed that information coming into the market would always be accepted by the market instantaneously, and that all of the market participants were rational participants. Now, you and I know, Andrew, that's certainly not the case. Most of my trading buddies are certainly not rational.
You might have a few on the chat today. You should probably. In fact, we've got Adam here. I don't know if he's one of your trading buddies. Love your work as always, Rich. So thanks, Adam. Good to see you. So I just want to go and before we move into I guess more of the strategies, which you've already started touching upon in our chat. Just a couple of comments in the chat here. So Ilya said mean reversion works until it doesn't, and then you get a good kick in the butt, good, get blown up. Blackjack says, I like that approach. I'm going to collect a normal distribution of performance that can see that. Sorry, I misread that. That can see the tails and reduce the left tail risk.
Yeah.
Yeah, that's it. And Zoran says, "Hey, Professor Rich in the house." So you got some fans in the chat here, Rich. Well
That's
done.
great.
So yeah, so that was incredible what you just shared with us, and I think there's also some other core principles as well that factor into successful long-term trend following, which we may touch on in a minute. But maybe if we can move a little bit more to the practical side, there's something that I saw when I was doing some research on your website. That sounded a little bit nefarious, didn't it? It's not like that at all. this thing, the barbell approach. Now, I've heard this approach before in the context of investing. I think I may have even seen it in Taleb's book, Nicholas Taleb. But you've got this barbell approach to trend following, which I thought was kind of unique. I haven't seen that anywhere else. Can you explain a little bit about what that is?
Yes. So I mentioned how I'm focused on the tail properties of the distribution, the left and right tails, and my trade outcomes. I don't want to achieve that left tail exposure. So when I'm targeting the left and right tails of the market, I'm choosing trend following models that both go long and short. So it's exploiting those opportunities. But with my trade outcomes, if for instance you had a symmetrical trading system that was applied to the market without any stops, without any small position size applied, you'd find that the trade outcomes actually mirrored the histogram of the market. It would have a left and right tail of the trade outcomes. But what I do with my trend following models is I diversify extremely widely across all liquid markets and with very small bets. So that diversification practice of diversifying across as many liquid markets as I can get my hands on means that I'm reducing my individual bet size per market to a very small amount. Now, in terms of the overall portfolio, it's a small bet size that ultimately protects you when you get into events that are unpredictable and extreme, such as if you remember the Swiss dollar depeg that occurred, where a lot of people were caught with that event. It was this huge flash crash over a period of a day or so. Now, something like stops won't protect you in those environments where things are moving very rapidly. But it's what does protect you is a very small bet size applied to any single market. So yes, on the Swiss dollar, we got massive slippage on that event. But when compared to the overall trade activity of the entire portfolio, which was extremely diversified, it was very minimal in terms of its overall impact. So I might have got a 2% impact on my overall portfolio, whereas my stock might have been positioned at 0.5% of my equity at that particular point in time. So yes, went through my stop, but it was a very small bet size that protected me. So for a diversified trend follower, massive diversification is essential for two reasons. It significantly reduces your bet size, which means that it significantly reduces your exposure to any single market as far as adverse risk goes. Also, with diversified systematic trend following, the aim is to select uncorrelated markets and things that when you hold them in a portfolio, portfolio is a very unusual device. It's what I call a risk sponge. So what I mean there is when you are trading at the portfolio level with hundreds of different return streams, you'll find that you're carrying a lot more risk in that portfolio than what you are carrying at the individual trade level. So if I had an individual market that I was trading a trend following system on, I'd find that it would be quite highly volatile. And when I put that into a portfolio, the uncorrelated nature of that return stream against other return streams create these offsets where when you're going into drawdown in one return stream, the theory of an uncorrelated portfolio is that other return streams are going to be profiting at those times you're in a drawdown. So The idea of an uncorrelated ensemble of markets to trade is the idea of using these correlation offsets to reduce your overall volatility. But it's a bit of a funny one because you are absorbing a hell of a lot of risk in that portfolio, and you're assuming the correlations are going to protect you, the uncorrelated properties of those markets. But what you can find is in extreme situations, suddenly all the correlations in those markets might flip to being very highly positively correlated. And then you're in trouble because you've got hundreds of return streams all doing the same thing. So if they're all going into a drawdown, that's bad with hundreds of them. But if you're all going into a magnificent uplift, that's fantastic. However, it's the bad you've got to protect against, because that's the thing that stops you getting future earnings if you go into risk of ruin. And the whole game of a diversified trend follower is to be in the game for the long term. And it's a concept relating to the need to look at what we call the geometric returns of the portfolio, as opposed to the annual averages or the average returns of the portfolio. So what the geometric returns do is it looks at the properties of that overall return stream of the portfolio over the course of time. And what it's trying to do is stopping these big drawdowns or these big events significantly deteriorating the compounding effect on that portfolio over time. So if you imagine if you had a 50% drawdown, it would take 100% uplift to get it back to where you were. And so that's the way compounding works. The adverse drawdowns of your portfolio really drag on compounded performance over the course of time. So the whole idea of a trend following portfolio is to achieve superior compounded returns over the long time. And the way it does that is by mitigating that adverse risk exposure. So when we are putting these portfolios together, we're looking at the principles of they need to be uncorrelated, and rather than looking at necessarily the correlation statistical properties, which can change over time, and we see that, say, in the equities market, where things might appear uncorrelated during a bull market, but when you get into a bear market, suddenly almost all equities experience the positive correlation, where we get the sea of red on the boards of the exchange, where everything's going down at the same time. So what you're looking at is you're looking at logical properties of the markets you select to ensure that ideally it's the logic that protects you as opposed to the correlation statistic that protects you. So the way that can be done is either choosing things that clearly are unrelated, like cocoa and petrol, cocoa and technology. They're things that are clearly unrelated logically, because there is no foundational correlation or causative structure that links the two together. You're looking at things that are causally disconnected from each other. So if I went to ChatGPT and I said to myself, I want to trade 20 markets from the S&P 500, I want you to logically work out what are the best uncorrelated stocks from the composite of the S&P 500 to trade using logic alone. It's going to come back at you with, say, 20 of the things that logically it finds an uncorrelated relationship with. And then what you say to it is, okay, now undertake a correlation analysis with those to see if your logical choice is valid. And then it does a correlation matrix. And it says, yes, it is valid. And that's because it was using a logical basis for selection. So Jerry Parker's a good one who does this in his logical framework. He says, I want to trade fried eggs, or I want to trade eggs. Let's look at a producer in the market that trades eggs. Now I want to trade a market that trades chips. I want to, if he looks at these logical disconnections. I now want to trade an energy market. I want to trade whatever, cocoa. So he's looking at the logical disconnection between things, which to me is a far safer proposition than relying on correlation statistics, which can flip and change over the course of time. So that's why I do like that. But another way of achieving that is by instead of looking at individual snapshots of what the correlation of markets are, you look at putting together ensembles of return streams using very long data sets, 30 years of history, etc., and looking at the way that those return streams map against each other. That's another good way of identifying logical, uncorrelated relationships with things. But anyway, that's half of the story. So this uncorrelated relationship is necessary to reduce the impact of adverse risk at the portfolio level and allow you to carry much more risk. And so by being able to carry much more risk at the portfolio level, it means that you can achieve much greater reward because of the risk-reward relationship. Higher risk comes higher reward. So what we do is we pack it into a portfolio with these uncorrelated relationships, and that allows us to carry this extra risk. But standard risk metrics won't pick that up. Sharpe ratio won't pick that up. What does pick it up are what we call path-dependent risk metrics, things such as what we call the MAR ratio, which is the relationship between your geometric returns or your compounded annual growth rate divided by the maximum drawdown. What it's looking at is the extremes. So you know how I was saying I look inside out? I'm looking at the impact of extremes in my portfolio. What is the maximum drawdown? That gives me an indication of extremity. Now, the reason that's important is from geometric returns, it's the adverse extremity, which is the thing that needs to be avoided. You want to stop that drawdown where possible. So then there's another reason for why we do this maximum diversification, and that's because it's our firm belief that any liquid market occasionally displays these chaotic properties. So when I look at the histogram of any liquid market over the long term, take whatever market you like, cocoa, any equity, soybeans, anything in cryptocurrencies, Bitcoin, whatever, over the long term, it displays these tails. When you see those tails, you know that the market has got non-linear mechanics in it. Now, what I mean is that these tails give the ability to get wins, say, 100 times your initial risk. So some of my portfolios might have a win that achieves 100 R. Good old Van Tarp defined what R was, and unfortunately he's not with us anymore. But what that, you can see the non-linear relationship there. 100 R for the risk of 1 R. That's a non-linear relationship. 1 R, 100 R. So the aim of our game is to achieve these non-linear outcomes because we know that the market exhibits these non-linear properties. But you never know when that's going to occur.
Yeah.
And the reason, so because you never know when that occurs, but you do know that is much more frequent than what a Gaussian distribution implies. This is where people say, oh, you're lucky being on that market, or you're lucky being on that market. But what we say is, no, we've developed a process that has reduced luck to a statement of two things: maximum diversification, three things. Capital preservation, we're in there at all times to be able to participate in the opportunity. And most people are never in there at all times participating in the opportunity. They've either been knocked out because of risk of ruin, or they've decided to go away for a week or 2 weeks when suddenly the markets have exhibited this behavior. You've got to have models that are systematic, automatic, are ready to take the trade at all points in time and preserve capital at all points in time. So you're always achieving, I'll come to the barbell in a second, but it allows you to exploit these significant opportunities that you'll never predict in advance, but your systems are there to exploit it. Now, what we talk about with the barbell approach is an approach we apply for this inside-out philosophy. What we're doing is we're applying one side of the barbell to strictly mitigate risk of loss of capital. At all times, we are preserving our capital. Think of that as one end of the barbell that is very conservative in nature, always protecting our losses, never letting a single loss become a significant event for our portfolio that's going to drag on our compounded performance. That's that left side of the barbell. On the other side of the barbell is where we run rampant and we take risk, because that risk is with what we call unrealized capital. It's the risk of the bet that suddenly becomes extreme. Now, because we've protected our capital at one end, we're prepared to let that extreme event go to its conclusion without any presumptive assumption that it's going to end. Because this is where our whole philosophy of trading this uncertain markets is that these trends can go for much longer than what any normal distribution would imply and what our brains will imply. Because the time that you get these massive trends is exactly the time the mean reverters say, oh, this trend's gone on for too long. Now it's got to revert. And they'll keep on coming in, trying to use that mean reverting opportunity, and their risk gets bigger, 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 bigger. And this is the negative skew you see in the mean reverting solution, where it doesn't revert. It just continues to go on and on and on. Yeah. And that's that negative skew we're trying to avoid to achieve our positive skewed outcome in our trade distribution. So the right side of the barbell is let profits run unabated, without tampering, because when you're in those tail regions of the market, things get incredibly unpredictable. So if you could imagine, a market displays lots of different properties. Sometimes it's incredibly predictable, known knowns, a single pendulum, left, right, left, right, left, right. The market behaves like that sometimes, and that's where mean reverters go, yes, I'll take this, yes, 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 win, 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 win. That's when it's known knowns, predictable in nature. But then it starts getting complicated. That's where, yes, there is a deterministic nature to it, but you need a very thorough model to be able to understand what the deterministic nature is. You need a complex model. That's a complicated market. Then you get to the complex market, and the complex market is when you don't know whether it's fundamentally deterministic or indeterministic. And there's sort of like, there's a split in that complex model where, because of the level of complexity, you really don't know whether it is fundamentally predictable or not. But then you get the fourth level of environment, which typically happens in transition events when markets go chaotic, where they are inherently unpredictable. You cannot predict them. And that occurs in those tail regions. So when we're in those tail regions, we're not wanting complex overlays in our models. We're not making assumptions of the trend is going to do this, or the volatility means that our position size needs to be this, or the correlation properties in our portfolio means our position size needs to be this. There are these techniques that are applied by lots of different trend followers, which isn't really appropriate in the tail regions that we're focusing on. Now, they are totally applicable for those people that are exploiting types of trends that we're not interested in. But for me, I regard myself as a tail hunter. I'm specifically focused on those tails, unpredictable, chaotic things. So I don't employ these complex overlays, because as soon as you add complexity to your model, you start overfitting your model to assumptions, overfitting your model to past history. So the simpler model gives more freedom to move. It's less overfit. So long as you cap your downside risk, so long as you always apply that barbell, that left barbell, but you let your profits run, means that you can exploit the right tails, whether it's long or short. You can exploit that for what the market delivers. So you're letting the market dictate your fate. You're not letting your complex systems dictate your fate. And so the way I view it is a bit like, I'm in this chaotic, huge storm environment. I've got a leaf blowing in that environment. I'm going to throw the leaf into that environment and let it blow to its conclusion. I'm not going to have a complex model that's going to try and stand up to those elements with a big house or a big building or something like that and get that the storm smashes it to bits. I'm going to be the leaf that just floats in that market condition, freedom to move, very few parameters, very simple model. It's always mitigating that adversity in that risk, but letting it run. And what I find is when I apply that under a very diversified framework, that's it. That's the process. No prediction. Look, Mum, no hands. And that's what I love about it. I can leave my models running continuously, and I don't ever have to worry about, oh, what's the FOMC going to do? What's this going to do? I don't have to worry about that at all, because my process is taking care of that.
Yeah. So as you're talking about this, these four levels of environment and the complexities around the differences in those. But then you're also saying that you want a simple model. It almost sounds a little bit counterintuitive, or maybe they're clashing. Can you give us some examples of like the practical side of this? If, like you said, the fourth environment is really chaotic, what would you do in a trend following portfolio or strategy to kind of adapt to that?
Okay,
Or would
so
you?
if you could imagine, let's say you did a back test over your data and you allowed the machine to optimize that model to basically look at the historical patterns of that past market data and come up with a model that best fits that pattern of activity in the past. It's going to come up with a fairly complex model with lots of parameters, very precise parameters that have fitted that model to the past history. Now, what that says is, okay, that's fine, good and well, if history is your basis to forecast what the future is going to give you. And so it's going to be a very precise model. The more precise things, you find that they become what in this Nassim Taleb would refer to as fragile. So if you can imagine a city is a nice, complex, adaptive system. It looks robust, like New York, massive city, very dynamic, lots of things happening, lots of agents all working together, looks very robust, but it is incredibly fragile because there are certain dependencies in that complex adaptive system that are inherently fragile, like the dependency on electricity. If you found that the electric dependency of that city was broken, suddenly we're all in blackout, suddenly you'll see anarchy reign, and suddenly the robustness of that city would dissolve. Now, as things get more and more complex, they become more robust, but also more fragile. As more and more parameters get involved, the system gets more what appears to be resilient, but the dependencies in that system become more specific. So when you look at financial markets and you look at who are the agents involved in the financial market, you'll get things like brokers, institutions. And when you look at a broker's relationship with the traders, you'll see it's a one-to-many relationship. There are hundreds of traders all dependent on the viability of that broker to be able to conduct their activities. You'll see these one-to-many relationships build up in these financial systems that make it appear very robust and resilient. But when you look at the interrelationships that exist in that system, you see how fragile they are. And one disruption of a major broker can suddenly send the whole markets in turmoil.
Yeah.
And that's because with these complex adaptive systems, the way these parts all come together is they are adding embodied energy into the system as the system gets more and more robust. It's a bit like a rainforest. When you see how a rainforest grows, you see a single canopy tree, a big tree that offers shade, and suddenly you see all of these different species using that single tree for a lot of different functions. There's a one-to-many relationship. Some use it for habitat, some use it to climb off, some use it for energy, some use it for resources. A one-to-many relationship exists in that rainforest, and it appears that that rainforest is very robust. But the way to smite that rainforest is simply kill that canopy tree. As soon as you kill that one foundational footing that everything is codependent on, and interrelationships with the one-to-many relationships, you see how fragile that system is. So in the financial markets, it's exactly the same way. We see this embodied energy, a bit like an avalanche. You see the snow at a higher energy level up on the slopes, and it appears stable. It appears nice and you can walk through it or whatever. But a rifle crack or a large shout will suddenly set one of those small parts in action at a higher potential energy, and suddenly, whooshka, the whole thing turns chaotic. That's how I see these financial markets work. They're verged on what I call the edge of chaos. And that's where all of these complex adaptive systems get their inspiration and adaptation from. They're continually reaching out into the chaotic landscape to change, to adapt, and then coming back to the edge of chaos. This sort of sitting on the boundary of this chaos, high embodied energy, that's where they deal with risk events, and that's where change occurs. And with our portfolios, this is exactly the same thing. We are embodying energy in our portfolios, what I call warehoused risk. It's a risk you won't see in the portfolio itself through sharp measures, but there is this building intrinsic risk. And it's the same as, think of Russian roulette, the game of Russian roulette. Let's imagine you rotate the barrel, your 6-barrel revolver, once. Then you give it to the first person to fire off into their head. 1/6 chance of dying. It's an awful, awful game. Give it to the next person without reshuffling that barrel. You can see that the risk is progressively accumulating as you're going through. You know that ultimately everyone's going to die when you get to that 6th barrel because you haven't reshuffled it. But when you do reshuffle it, there is still contingent risk that over a sequence of events perpetually builds. That's what I call warehouse risk. That's the risk associated with risk in terms of events over time. Now, if you imagine when you get the best sporting people in the world, let's say the best snow skier or the best runner or the best high jumper or whatever, what you'll find is when they do a single event, there is always the chance of a cataclysm occurring in that event. Let's consider a snow jumper who goes off the snow jump. Let's say there's a 30% chance he's going to come in a crippling fall. It's going to break his leg, and it's going to therefore totally destroy his chances of winning the long-term championship that might be 20 of these events. So the risk of a single event might be 30%. And someone might say, yes, that's a good risk in taking. It's 70% chance of winning that event. However, for someone with a career in the game, it's a sequence of contingent probabilities. The first event and the second event winning, the third event winning, you'll see that it's a contingent process where the 30%'s being multiplied by each other, and you'll find that there's a changing risk profile as you go to sequential returns. And it's exactly the same as the career of a trader in this game. Those who meet risk of ruin, they forego any future possibility, any future profit. They will never get compounding. They're out of the game. But those who survive, that they're the ones that are turning what I call that, what we've been talking about, this big term for it, it's called the financial markets are a non-ergodic system. Okay, that's a big mouthful. But what it's meaning is that the average experienced by all of the participants at a single point in time is different to the average experienced by an individual over the course of time. So when you get an ergodic system, the average at a point in time across all of the samples versus the average over time of all the samples is the same. And economics has always traditionally viewed averages like that. However, in financial markets, they're non-ergodic, which means that the average that occurs at a particular point in time over all participants will be different to the average experienced by the individuals.
Yeah.
And what you find is this is because when you are trading sequences of events over the course of time in the financial landscape, the conditional probabilities are changing all the time. Markets are adapting, they're changing. Risk might be higher at one point in time, lower at another point in time. So you've got to be able to map all of those risk events in a contingent way to ensure survival, because there's a good chance with those leptokurtic tendencies of those markets, occasionally unpredictable, they're going to wipe you out unless you prepare for them. But if you have a process that protects for them all at all times, you will turn your non-ergodic process into an ergodic one. That's the whole game of what we're trying to achieve with our trend following process. We want to achieve that ergodicity, but we recognize that markets are non-ergodic. And a good example is if you start with $100,000 of capital, and let's say your chance of a win is 60% and your chance of a loss is 40%. If you, with $100,000, let's say you lose the first time, so that's 40% off your $100,000, you're down to $60,000. Let's say you have another loss, you're then down to $20,000 or whatever. Remember, the clawback to come back to the original position is so much harder than the downturn. That's this effect of contingent probabilities on your investment wealth. So when you're looking at the wealth, so this is where the compound annual growth rate, the geometric return, becomes so important, because we're looking at the path-dependent nature of when these adverse events occur. And if you're looking at the nature of that over the time interval, is a much better way to achieve compounded wealth over the long term if you always prepare for the unexpected over the long term.
Yeah. So if we go back to your example of New York, so it looks like a very robust and stable system, but then your example was cut the electricity and we'll see how robust it is, right? So
Yes.
it's fragile. How do you do the same for your portfolio and your strategies? Like you might think, okay, I've got something really robust here, but there must be fragile elements along the way. How do you go about identifying those?
So let's say I'm trading a portfolio across, let's say I've got 100 markets. Let's say I'm trying a very simple trend following system. So what I'm saying is with a simple system, I'm not looking at it being overfit to a market. So let's say I test that simple system with maybe only 6 parameters: an entry parameter, an ATR based stop level, a trailing stop, ATR based trailing stop level, let profits run. So I've got no profit target there. Let's say I've got 6 parameters in that model. Very simple model. That means that when I apply it to an individual market, let's say I apply it to a Forex market such as Euro USD, what I find is that simple model will not overfit to that individual characteristics of that market. It's that because it's a simple model, it's going to allow a lot of room to move. The simpler the model, the less specific, the less finesse, the less precise it becomes to that individual market. So what I do is I say, all right, that model, that trend following model with those very simple parameters works well on that market. That's one possible history. So let's say I tested over 30 years, and let's say this simple model only trades a few times because it's only focused on trading where we get material events occurring, materially big trends or materially short trends. So it might have only traded 30 times over that 30-year interval. And therefore, it's very underfit to that individual model. If it was trading 200 times, 300 times, 500 times to that single market, it would be overfit to that model. It would be looking at all of the most frequent patterns that occur in that market over the 30-year history and accommodating to that. It'll be precise. And with the precision becomes fragile. With the precision comes fragility. So what I then say is, right, it's past that single market. That's one possible history. Now let's apply that simple model, same parameters, to 100 markets over 30 years of history. So now I'm massively increasing my sample size from, say, 30 trades for a single market times 100 markets. That's giving me 100 alternate possible histories to test that model on. So once it's passed, if it's passed that test and it hasn't gone to oblivion and it's managed to produce a geometric return over that entire process that doesn't have that adversity, that's a tick box. That says, tick, that's a robust model. It's not an overfit model because its applicability is not just to Euro, it's to all of these other markets. So now I've got that one model in there. I say, great, let's try another model. And what I do is I get diversification not only across my markets, but I also apply diversification across my systems. I trade what we call an ensemble of trend following systems. All of the trend following systems obey the golden rules: cut losses short, let profits run, but they are all differently configured with different entries, different exits, etc. Now, and then they're applied across all of my portfolio to make sure they're still robust. So at the end of the stage, I might have 10 models that are robust across all of my 100 markets. Then I now go into the future, the unknown future with these trend following models, with my ensemble of trend following models. And what I find is that having one model means that you're reliant on a particular condition that suits that model, because to be able to capitalize on trends, it's not just a function of what the market's doing, it's a function of how your systems are responding to that market. So you need two things aligned: the nature of the market offering trends and the ability of your model to capture those trends. One single model doesn't catch all of them. There will be times where it's whipsawed out of that market, or it doesn't participate in that trend simply because of the nature of trends being so diverse, so unpredictable in character. You can never sort of, by applying an ensemble, you've got a much greater chance of exploiting those opportunities in the markets by not being overfit to a single model and not being overfit to a single market. So it's all about overfitting, and it's all about what I call selection bias. So it's all very well and good to look at a model and say this would have performed well in the future. And a good market here, Andrew, is that I have cocoa in my portfolio now. Up until a year or so ago, nothing happened in cocoa for God knows how many years, and everyone was saying, "Richard, what are you using cocoa for? Historically, it's demonstrated that it doesn't trend. You should be applying mean reversion to cocoa." Now, the thing is, I'm not participating all the time in cocoa. When it's mean reverting, I'm just not present. I'm not active in that market, but it's still on my watch list. And when it does start exhibiting these material trends, I'm on it. So I got on it last year, and bang, now cocoa is offering this magnificent trend. Now, that was not a predictive process. The model was always there in my watch list. It was one of my 100 markets or whatever that I trade. I've got my 10 ensemble models always ready there to participate. Sometimes one model starts and it gets whipsawed out, but that's only one model here and there, 2 models here and there. That's when things aren't materially trending. But what you'll find, it's a bit like pyramiding, Andrew, is that when the material trends start with an ensemble of models, you not just get you get your first system activated, and because it's a loose pants model, in other words, freedom to move, simple parameters, one model's active, then another model will become active, then another model will become active, then another model will become active. So by the time you're riding these extreme trends, you'll find that all of your 10 models are all active. That's when you're getting what I call non-linearity squared. I'm not just getting the benefit of one model on a trend, I'm getting 10 models on a trend, and I'm getting this multiplication of this non-linear outcome in my trade distribution. It's very much like pyramiding into a trend. And that's because I'm applying this barbell approach, mitigating risk all the time on my left side, letting profits run. But then as more and more systems get involved, yes, I'm riding a lot of unrealized equity, but hey, that's my punt. That's my baseball bat swinging for the covers. So I'm very conservative on one end with my realized capital, protecting my capital at all costs. But gosh, I hit the baseball bat hard on the right end of the barbell when I just let it all ride. And people say, you're a fool. You should be taking some of those profits off the table. And I say, well, can you predict when this one's going to end? And then I show them a leptokurtic distribution. I say, what chances have you got of knowing how long this trend's going to end? When's it going to end? You know what I mean?
Yeah, exactly. Yeah. So then, just doing the math there, you said, maybe as an example, maybe this is realistic: 10 ensembles, 100 markets. That's a lot of that's a lot of models.
1,000 systems. Hence, systematic, algorithmic. It's something that, in my world of the tails, you cannot afford to be discretionary, simply because we're not octopuses with 100 arms, and sometimes you are very active in a portfolio. You've got to let the algorithms do this themselves, and also, the only way to have faith in your validation of your process is having something that's replicable. So it's got to be systematic. So in my world, it's algorithms central, man. It's everywhere. Yeah.
Yep. We've got a bunch of questions here in the chat, which we'll get to in a minute. But for those who maybe are just starting out or only have a couple of models, and they've just heard you say they need 1,000 or 1,000 would be good, it's like, holy crap, how am I going to get there? It's overwhelming. What would you recommend to those people?
Treat it as a venture where, look, you start off small. Everyone starts off small. Look, what I've done is, in my journey, I've had to look at shortcuts. Like, I don't have unlimited capital like Jerry Parker and some of the big boys out there who can trade these massive diversified portfolios with futures. So the shortcut to me was using alternative products such as CFDs that allow you to achieve that level of diversification by trading microlots. So you can achieve massive diversification in the CFD market because of your ability to trade microlots. However, there are certain implications of that product that you need to take into account with your workflow process. The costs are necessarily higher. They're higher because of the convenience the market offers you, but you've got to weigh up, are the additional costs of the holding costs, called swap, in our world of CFDs, or are the costs of the additional brokerage or commissions or whatever, is it worth it in the context of the additional diversification benefits brought by that process? Now, I'd say yes, and that's why when I have small levels of capital, my main aim is how do I achieve maximum diversification with limited capital? So I've had to go down that path. But as you progress and get more and more capital, ultimately you should be going for, yes, I want to trade futures, or I want to trade, as Jerry does, single stock equities or whatever, diversified portfolio across numerous asset classes. You know, you're looking for the things that give you the best bang for buck. And with growing capital, these opportunities emerge as you progress. So when you enter the game of diversified trend following, capital is a prerequisite. So treat it as though you're on trainer wheels to start with, and your aim is whatever profits or whatever you can gain out of the process that you're achieving, always use it to get extra diversification in terms of systems or markets. Ideally, markets first, and then you can start experimenting in systems down the track.
Yeah. Okay. Well, that was to answer. I guess you kind of answered Neil's question there. How much capital do you need? So thank you for answering that one. Now, a couple of questions from the chat here. I saw someone ask about risk on that left, on the barbell. Here we go. Found it. From Chris. Thanks for the quick question, Chris. Rich, do you have any favorite methods of capping downside moves in individual instruments?
So as I mentioned before, a small bet size is the best way to stop adverse risk affecting the overall portfolio. But then I'm a big one for setting stops and trailing stops. I use ATR-based trailing stops. So if you could imagine, as a trend gets underway, when I initially take my entry position, there's always an accompanying stop put in place. A lot of people don't use stocks with diversified portfolios, but the reason I use stops is not necessarily the reason that a lot of people think that I use stops. So if you could imagine, I've said already the small bets are the things that protect adverse risk. So why do I use stops? I use stops because it gives what I call a risk release valve in the portfolio. So it stops me carrying risk of any individual return stream in the portfolio by releasing it. Now, in this world of portfolio management, where you can consolidate risk into your portfolio, you need a valve to get rid of that risk. And the only way you can get rid of risk is to exit the trade. So rather than hold on to the risk by averaging down or whatever, by having the stop valves in place, it's continually releasing risk. And what that means is your portfolio is always ready to take on new future risk, as opposed to being weighed down by holding past risk. So you're always releasing that risk. That's why I use stops in my portfolio. So I've got an entry when I take and an initial stop. Then when the profit starts moving in my way, I've got a trailing stop using an ATR-based mechanism. It's called a chandelier technique, where behind the moving price, either up or down, is a trailing stop that ratchets behind you. And what that means is that when the trend ultimately ends, which none of us can predict, you don't get clobbered back to your original stop. The trailing stops are not too far away from your price. So it means that you just don't lose too much off the table when that trend decides to end. But as a trend follower, you never catch the beginning of a trend. You never catch the end of a trend. You capture the meat of the trend. So I'm participating in trends when they start to get extreme, and then I'm out of a trend at the time it's come off its high or low. So that's the way the trailing stop works. And that's good enough for me. But I'm not setting a profit target in any way, shape, or form, because I let profits run, and I never know how long that's going to be.
Yep. Okay. Thanks, Rich. Here's a question from Ilya. Thanks for the question, Ilya. You've kind of touched on a little bit of this already. What instruments do you trade, and can you go into indicators and parameterization?
Woo! Oh, that's a big word.
These big words always get me, Rich. They always get me.
Okay, so at the moment, look, I've got about 100. It depends on what you're referring to, because I've got numerous hats I'm wearing. But with my what I call my battleship, which is my that's what I trade on my own as my hobby. That's run by CFDs. So at the moment, I've got it across, I think I've done a rework of that portfolio. So it's about 68 markets at the moment in CFDs, but I've got 10 different models working. So the markets I'm trading now, I'm not a big one for deciding asset class diversification. So what I'd rather do is let the data tell me how correlated markets are over the long term. So I'm always testing things over the very long term. So let's say I had a possible universe of 150 CFD markets. I wouldn't make the assumption of bundling them up into asset classes. What I'd first do is I'd apply my trend following models on those 150 markets, and then I'd get return streams over 30 years for all of those 150 markets, let's say. Then when I'm bundling those return streams together into a portfolio, I'm looking at all of their properties over that entire 30 years period and how they collate as an ensemble together. So I'm not looking at individual correlations at points in time. I'm looking at the entire properties of the return streams over that 30-year period, and I collate them all together with some very high, heavy-duty chugging on my PC, which is swapping in and out return streams into collations, looking at which is the best collation. So what that does is out of the 150 markets, it's naturally coming to the most uncorrelated properties in that collation without having to decide it's in this asset class, this asset class, this asset class, or whatever. It's using data and the history of data over very long-term data sets to decide which ones, as opposed to the assumption of asset class diversification, because we always assume that commodities is different to Forex, is different to bonds, is different to this. They're assumptions. We've got to test those assumptions. So I let the data do that testing. As far as the models themselves, so I'm using, there's about 6 core models that I'm using. Okay, so one of them is the Gaussian breakout, which I love. So I'm looking at different forms of entry with my ensemble of models. And the reason I'm doing that is that the interrelationship between how markets move and how the systems relate to that market, I'm trying to spread my tails through my distribution of returns throughout the entire return stream, not just clustering them in one place, like in 2008 when the markets were collapsing. Typically, trend followers all did very well during that environment. And in 2020 through to 2022 or whatever, they did very well in that environment. What I'm trying to do with my ensemble is broaden that distribution of outliers throughout the time series to avoid these periods or these periods of long-term, what we call droughts. So with the system ensembles I'm applying, we avoid the droughts. And the systems I'm deploying, Gaussian breakout, classic. Moving average crossover, classic. Bollinger breakouts. So what I do is I do a Bollinger reversion into trend. Now, the reason for that is that particular system allows me to get a very good risk-reward relationship. You know, when we're getting a long-term trend and we get a retracement out of that trend and then back into that trend, it allows you to get magnificent position size. So I exploit that with my Bollinger Band mean reverting into trend. I've got a Davis box breakout, which is using the principles of a congestion box, which ultimately breaks out either long or short from that congestion box. I'm using a regression line trader, which is looking at using a standard deviation regression and a regression line on the price data to get a level of breakout. So I've got lots of different forms of breakout and techniques to give me diversification in my trend following models. But every common to every one of those models is they all cut losses short and they all let profits run.
Yep. Okay, thanks, Rich. I've got a question here from Jason. And thanks, Ilya, for that question. That was a good one. Jason would like to know, do you hedge your portfolio when there is market risk?
No, so if you could imagine, because I trade both long and short, and because I've got an ensemble of systems, let's say I'm on a very big trend. Let's say cocaine, very big trend, and we start seeing the trend turn. Now, because I'm trading an ensemble of models, what I find is that when the trend is all displaying let's say it's going along the upward direction, I'm progressively getting more and more commitment out of my ensemble. So let's say at the end of that trend, we've got 10 models all firing. As soon as that trend changes, I find that some models start going short because they're the short-term models. They're of the ensemble. They're the shorter-term models of the ensemble, like the congestion box breakout. Tends to be more short-term in nature. So as the trend's turning, some are starting to commit in the short trend, while others are still committed in the long trend. There is a degree of hedging. That's automated. That's the portfolio working as it should.
Yeah.
So when I do get the full turn, I find that some of those systems have actually compensated me for some of the loss of the give back when that trend turns. But because I'm using this particular diversified portfolio, long and short, hedging to me, I don't need hedging, because this particular portfolio, you need hedging when you've got a portfolio such as a buy and hold portfolio in equities or in bonds or whatever. You need hedging because it's asymmetrically orientated. The buy and hold is only looking at the upside, the long only aspects of that portfolio. So you need hedging there. But in a diversified trend following portfolio that's both long and short, you'll find that the portfolio is automatically hedging itself with the nature of the systems and when they're being deployed into the trends, etc. The periods of time we've got to worry about as trend followers, and of course there's weaknesses in every system. The periods of time we've got to worry about is when markets are being very predictable. When they're being very predictable and they're mean reverting or whatever, that's when we get lots of these nasty whipsaws. And so that's why trend followers tend to hate mean reverters and mean reverters tend to hate trend followers. It's just the way of the world.
It's like the old PC versus Mac debate, right?
Yes, exactly.
We'll start wrapping up here because I realize we've gone over a bit time a little bit. But there was a question from Zoran about long-term and short-term, which you kind of just touched on there. I might just pop this one up on the screen and then we'll start wrapping up afterwards. Here we go. Now, this is kind of a little bit specific about moving average crossovers, but can you talk a little bit about how do you look for models that work both short-term and long-term, or do you adjust them, or how do you look at that?
So Zoran, the way I work on this is I adopt a workflow process. So I don't come to my model. I've got my models already designed. So I work with a programmer, and his name's Fred, and Fred comes back to me with 6 models, like the ones I've discussed, Donkin breakouts or whatever. All of the parameters at that point in time aren't assigned. Now, what I then do is I put them through this extensive testing in my workflow where I'm looking at 30 years of history, and to be applicable across all of my markets of my portfolio, they've got to be universally applicable. And what I do is I let the parameters run freely to choose what is the optimal universal parameter set for all of those markets. Now, the entire process therefore starts, it does have the capacity to spit out parameter sets that are short term or medium term or long term. But what I find at the end of my process, after applying it to all of this data and across multiple histories, is that they're all naturally plotting at what I call medium to long-term lengths. Nothing survives, as far as in my world of the tail regions, nothing survives with a short-term basis. And when you talk short, medium, and long-term, it's a bit like a how long is a piece of string argument. What do you mean by short, medium, long-term? It's a bit like everyone talks of trends differently. No one can say what the single trend is. But the way I view it is that short term to me would be anything up to, say, things that would have a maximum hold of up to 2 weeks, I'd call short term. Things that would have a maximum hold up to 1 year, I'd call medium term. Things that would have a maximum hold up to 3 to 4 years, I'd call long term. And what I'm finding is that my models are settling on parameters that are universally applicable. This is what the data is telling me. It's not my assumption. The data is telling me that, so with a Donkin breakout, I'm looking at a Donkin channel of greater than 50 bars look back. Moving average crossovers, might be the 5200 crossover. It's settling on these parameters that are universal, but it's not through any assumptions on my perspective that I want to be medium term or long term. It's just what the data is telling me. And it's just the way with my simple models it works. However, if you applied complex models to that same workflow process, it might come up with much shorter term models. And what I've found is that if you are trying to deploy unpredictable models that are suitable in unpredictable markets, where you're not trying to overfit to any precise condition, allowing room to breathe, you'll find that it settles on medium to long term. But if you want to become prescriptive, you've got to go short term. That's why mean reverting models, they tend to be quite prescriptive in their design, and they are particularly trying to attack a precise pattern, and therefore they tend to have more variables involved, and they're shorter term in nature. That's the way it's sort of the relationship between system simplicity and time frame sort of tends to work for my workflow processes.
Yeah. Okay. Thank you very much, Rich. Now, I was going to leave the questions there, but I want to try and slide in one quickly for two reasons. Firstly, this is a person who's been following the show for many years. And also, he gave you a really nice compliment. So how about I share the compliment first?
Oh,
and then we'll finish up with the question. Okay, so here we go. It's Huz, or Huz, I don't know how to pronounce the name. I have high respect with Rich in the trading space and trend following arena. So now you've got your compliment. We've
Thanks very much, Huz.
And Huz's question was market regimes. Do you apply them? Are you using them?
No, look, I don't. Look, I realise that they can work for some people, but they don't work for me. And that's because I'm using this process. So the whole basis of my understanding of these magnificent things called outliers that I'm hunting for, these major trends, they're incredibly unpredictable in nature. So, and what I'll find is that market regimes are more associated with repeating patterns. So the way I see the markets over the very long term is we do get these periods of market regime that turn from here to here to here. And in these different regimes, correlations differ, averages differ, trade statistics differ. You're continually going into these different periods of these markets as they adapt and evolve. And that's because I view these markets as exhibiting all these different possible predictable patterns, unpredictable patterns, or whatever. Now, if I try and adopt a system that's trying to exploit a market regime, I've got to I have to overfit to the market regime I want to exploit, and two is I've got to assume the length of term that regime persists. Now, in my world, my unpredictable world of tails, I've got no knowledge of this thing. I'm dumb when it comes to this. There might be a lot of better traders out there that can use market regime filters and things like that to improve their efficacy. But in these tail regions, which are very unpredictable, and I'm relying on this unpredictability because if you imagine in this competitive landscape where I'm viewing 90% of participants as predictive modelers and only 10% of participants as non-predictive modelers, when the predictive modelers fail, and that's because the predictive outcomes or the use of market regimes or the use of assumptions that things will predictively evolve in a particular way, when those models fail, they flip over to becoming us, because what they're doing is they're exiting from their predictive models. And when they exit from those predictive models, it creates this feedback loop, an amplification feedback loop that makes these trends go even more. So if you examine these crashes and these times we go into these incredibly unpredictable environments, you'll find that it isn't a case of a major crash and then a dissipation of the crash. You usually find it's a case of it slowly turns, starts getting faster, acceleration increases, and you get what they call these massive capitulation tails, where everything's happening, people are just giving up, people are going to risk of ruin, people are bailing out of the trades. That's where all of the predictive modelers are panicking, but their actions in trying to avoid that calamity is amplifying that trend. And that's where I get my best returns, when the markets are absolutely having a conniption. That's not using market regimes. That's just using a process that's capitalizing on the tail properties, where and when they might happen, and no one knows when.
All right. Well, thank you very much for that, Rich, and thank you very much for your time today as well. We appreciate you being so gracious about us going over time. So thank you. And I know, we could probably talk for a few more hours about this. There's a lot to cover, and your depth of knowledge is incredible. So thank you very much. So how can people learn more from you or get in touch with you?
Well, they can certainly get on my Twitter feed. So I'm at RichB118. I'd love to welcome you onto the Twitter feed. LinkedIn, I'm on LinkedIn at Richard Brennan, I think. And then on, you can get onto my retail trading website called ATS Trading Solutions, or the Traders Outpost.
I've got that one ready.
ATSTradingSolutions.com. Or Aussie Turtles. I participate with Adam with Aussie Turtles, and what that's doing, that's showcasing classic trend following, the Turtles way, and it's got some big plans in the future, holding some training programs and things in Australia and also outside of Australia. And the Algorithmic Advantage podcast, you can get me on there, where I co-host with Simon. That's always great. We have a lot of guests, but look, it's been great, Andrew, being on here, and I really appreciate you having me on. Thank you very much.
Oh, it was a pleasure to have you on, Rich. Yeah, it was great. And I've got a whole page of notes here for myself as well. So I'm going to have to go back and listen to this one for my own trading as well. So yeah, thank you very much for that. And for anyone who's watching or either live today or in the recording and appreciates Rich, please leave us a like, and remember to subscribe to the channel so you're notified whenever we release any new content. And Rich, so any closing thoughts before we finish up for today?
Look, I'd love you all to become trend followers. Of course, you need the personality to sort of deal in our awful world that we call trend following, because it's not an easy world to navigate. You've got to be very counterintuitive. But I welcome you all over to here, and best of luck trading, everyone. And hope to see more of you, Andrew.
All right, cheers. Thanks again, Rich. Thank you, everyone, for attending today. Hope you enjoyed it, and catch you soon. Bye.